Welcome back to Dinar Today, your trusted source for clear, grounded, and intelligent coverage of global currency developments with a focused lens on Iraq's evolving financial future. Today's report is not built on hype, rumors, or viral headlines. Instead, this is a deep, structured analysis designed to help you understand why the conversation around the Iraqi dinar, especially the 25,000 IQD note, has resurfaced with renewed intensity as we move through the 2025-2026 economic cycle. For many viewers, this topic is personal. Some have held physical dinar notes for years, even decades, quietly watching as narratives shifted from optimism to skepticism and back again. Others are newcomers, trying to understand whether the story is rooted in economic reality or simply recycled speculation. This episode is designed for both groups. We are going to walk through history, current reforms, global context, risks, misconceptions, and realistic scenarios step by step so you can make sense of where things truly stand. The idea that a single 25,000 IQD note could one day be worth tens of thousands or even more has long captured imaginations. But imagination alone does not move markets. Currency value is shaped by institutions, policy discipline, credibility, productivity, and global integration. What makes this moment different is not a rumor, but a convergence of measurable changes happening inside Iraq itself. To understand why attention has returned to the Iraqi dinar, we must first acknowledge the past. For years, dinar discussions lived mostly on the fringes of the internet. Predictions were often disconnected from policy reality, timelines were repeatedly missed, and trust eroded. Many observers dismissed the entire topic outright. That skepticism was not unreasonable. Iraq faced chronic political instability, weak banking infrastructure, limited transparency, and heavy reliance on oil revenues without sufficient diversification. However, economies are not static. Nations evolve, sometimes slowly, sometimes unevenly, but change does occur. Over the past several years, Iraq has been undertaking a quieter, more methodical transformation. Not flashy announcements, but structural reforms that tend to matter far more over the long term. These changes have begun to shift how serious analysts view Iraq's monetary future. One of the most important developments has been Iraq's renewed commitment to institutional reform. This includes modernization of banking regulations, strengthening of anti-money laundering and counter-terrorism financing frameworks, and efforts to align domestic financial practices with international standards. These are not optional checkboxes. Without them, a currency cannot participate meaningfully in the global financial system. At the center of this transformation stands the Central Bank of Iraq. Historically, political interference undermined monetary stability and contributed to inflationary pressures. In recent years, the central bank has emphasized greater independence, improved governance, and clearer communication. These changes may sound technical, but they are foundational. A currency gains value when markets believe monetary policy is predictable, disciplined, and shielded from short-term political demands. Transparency has also improved. While still far from perfect, the Central Bank of Iraq now provides more consistent reporting on reserves, exchange mechanisms, and policy objectives. This transparency matters not only to international institutions but also to correspondent banks and foreign investors who require clarity before engaging in cross-border transactions. Another major shift involves Iraq's engagement with global financial institutions. Cooperation with organizations such as the International Monetary Fund and the World Bank signals more than access to funding. It represents a willingness to accept oversight, follow best practices, and submit to external evaluation. Countries seeking currency normalization do not avoid scrutiny, they invite it. These relationships also provide technical guidance on fiscal discipline, debt management, and financial sector reform. Over time, this external validation contributes to confidence, which is the invisible backbone of any credible currency. Now let's address the focal point of today's discussion, the 25,000 IQD note itself. Why does this particular denomination attract so much attention? The answer is straightforward. Higher denominations amplify value changes in absolute terms. If a currency appreciates, the numerical impact on larger notes appears dramatic. This mathematical reality often fuels emotional projections. It is essential to distinguish between arithmetic possibility and economic probability. Yes, mathematically, if the Iraqi dinar were ever valued at $1 per dinar, A 25,000 IQD note would equal $25,000. At $3 per dinar, it would equal $75,000. These figures are not forecasts, they are illustrations. They help explain why speculation focuses on large denominations, but they do not guarantee outcomes. Critics rightly argue that today's Iraq is not the Iraq of the 1970 seconds or 1980 seconds. The global financial system has changed. Exchange rate regimes are more regulated. Capital flows are more controlled. International compliance requirements are far stricter. All of this is true. But it is also true that Iraq remains one of the most resource-rich countries in the world. Oil continues to provide a powerful revenue base, but Iraq has increasingly acknowledged that oil alone cannot sustain long-term stability. Diversification efforts, while still early, are underway. Infrastructure investment, private sector development, and digital banking initiatives all point toward an economy seeking broader foundations. Inflation management is another area of progress. Once a persistent challenge, inflation has become more controlled through improved coordination between fiscal and monetary authorities. Stability in prices is not glamorous, but it is essential. Without it, currency appreciation is impossible. As these domestic reforms unfold, attention has also turned to Iraq's exchange rate regime. Discussions around modernization, managed adjustment, and eventual increased flexibility have gained traction. Rather than a sudden revaluation, many economists believe a gradual appreciation or managed float would be more realistic and less disruptive. In a gradual appreciation scenario, the currency strengthens incrementally as confidence builds, reserves stabilize, and international usage expands. This approach allows markets, businesses, and households to adapt without shock. It also reduces speculative volatility, which can destabilize emerging economies. For long-term holders, gradual appreciation can still be meaningful. However, it requires patience and realistic expectations. Currency markets are cyclical. Periods of progress are often followed by consolidation or pullbacks. Emotional discipline becomes just as important as financial knowledge. History offers useful context here. The Kuwaiti dinar is often cited because it collapsed during the Gulf War, losing most of its value amid occupation and uncertainty. Yet following liberation, institutional rebuilding, and decisive policy action, Kuwait restored its currency to one of the strongest positions globally. Iraq's situation is not identical, but the example demonstrates a broader truth. Currencies are not permanently defined by crisis. That said, optimism must be proportional to evidence. Iraq continues to face political fragmentation, infrastructure gaps, and external pressures. Progress is real, but it is uneven. Recognizing both potential and limitation protects investors from emotional extreme. No discussion of the dinar would be complete without addressing the risks of misinformation and fraud. Over the years, bad actors have exploited hope by promising guaranteed exchange rates, exclusive redemption centers, or insider access. These claims rely on urgency and secrecy. Legitimate financial events do not operate this way. Any legitimate currency adjustment would involve regulated financial institutions, public policy announcements, identity verification, compliance checks, and tax reporting. There would be no secret invitations, no private emails, and no pressure to act immediately. Understanding this reality is one of the strongest defenses against exploitation. Preparation remains the most practical strategy. For those holding physical dinar, maintaining documentation of purchase, ensuring notes are authentic and undamaged, and understanding local tax obligations are prudent steps. Preparation does not assume an outcome, it reduces stress across all outcomes. Equally important is personal planning. If value were to increase, what would you do? Eliminate debt? Build savings, invest conservatively, seek professional advice. Answering these questions ahead of time prevents impulsive decisions driven by emotion rather than strategy. For many long-term holders, this journey has been as emotional as it has been financial. Years of skepticism, delays, and disappointment test patience. Yet endurance itself becomes a form of discipline. If progress continues, any eventual change will represent not just financial gain, but validation of patience. As we conclude this extended analysis, the message is clear. The Iraqi dinar is not a lottery ticket, and it is not a guaranteed outcome. But neither is it frozen in time. Iraq is rebuilding institutions, modernizing its financial system, and strengthening global relationships. These are the foundations of credibility. Stay informed, stay skeptical of hype, stay prepared, and remember, real opportunity rewards discipline far more than excitement. This is Dinar Today. We follow the facts so you don't have to follow the noise.